Everybody, Geoff Hyland here with the Hyland Group eXp Realty in Prescott, Arizona. I want to give you your November 2025 market update. We've got quite a few things to talk about today. Number one, we did see a little bit of a reverse in our inventory. So inventory has started to slide down, not too unexpected this time of year. So now as of November 1st, we have 1,149 site-built single-family homes on the market. As you know, we've been hanging in the 1,200 range since June, so we've come down off of that. Right now, sitting at about a 4.5 month supply. Still pretty strong demand. 253 properties went pending last month in October, and 258 closings during that period of time as well. Interest rates are in that 6.25 to 6.35 range. Obviously FHA and VA, you can get pretty close to 15 years, obviously more attractive than that as well. Pending sales for October of this year were up by nearly 6% compared to a year ago, October of 2024. So again, with the interest rates being, sliding down, continuing to ease a little bit, we are still seeing really good buyer demand out there. So, I talk to people all the time and they're saying, man, the market's really slow. It's not really slow. There is a lot of buyer demand out there. There's plenty of transactions taking place. If you look at 259 pending sales for the month of October and you compare it to, for example, May, everybody's perception is, oh man, May, June is a great time. Well, there were more pending sales in October than there were in May. So the market is very active right now. Again, disclaimer, your home has to be priced correctly, marketed correctly, and you really do have to go the extra mile to set yourself apart because there is more options for buyers to choose from in the marketplace right now. Now, that being said, values since May, we'll talk about Prescott for right now. Last month, Prescott did slide 2.98%. And if you look at what's been going on since May 1st, the market in Prescott has declined almost 8%. So sellers are getting more and more realistic, it looks like, in terms of pricing. The active inventory has been on the market now for 124 days, priced on average 12.75% above the average price per square foot. So those active homes are continuing to languish because pricing in most cases. Days on market, MLS wide, is running about 84 days. So just to reiterate, average home is taking 84 days to go on the market and attract an offer. And then when you start looking at those pending sales, a lot of times you'll see 1, 2, or 3 price reductions during that time frame. So they're chasing the market down. Be careful about doing that. Everybody's really tempted to price high. We can always come down later. If you have questions about that, feel free to reach out at any time. Generally what I see is if you price the home closer to market value in the beginning, it's going to net you as a seller more money as opposed to chasing the market down, especially with the trend that we're seeing right now. So Prescott declined 2.98%, PV 1% decline in the last 30 days. So we're keeping an eye on that. Now, there's a lot of talk in the news. I've been getting a lot of phone calls. Hey, what about these 40 and 50 year mortgages? Let's talk about why President Trump is talking about or entertaining these ideas, which, by the way, is not a new idea. These have been talked about in the past. I read a stat that the median price of a U.S. home in September was $415,200, which is 50% higher than September of 2019. That's why these conversations are happening. The average homeowner, first-time buyer, is 40 years old. Historically, it was closer to 26. So what they're looking at is, hey, how do we work on the affordability piece to get more buyers to experience home ownership? And so that's why they're looking at it. There's pros and cons. I'm not here to say for you and your situation what's right, what's wrong. It could be a really good fit for some people. Obviously, some of the pros, lower monthly payments, right? It reduces that barrier to get into home ownership, which, for a lot of first-time home buyers out there would be great. Even for non-first-time home buyers, you can get into a house, you're expanding your family or want to move up. That lower monthly payment could be attractive, obviously, easier qualification, and there could be an increase in, your purchasing power. And there could be, increased buyer activity as a result of it. Some of the cons could be you're going to pay a lot more money over the life of that loan. And so that's where I'd be really careful. Hey, can you qualify for a 30-year? You look at a 15-year rate versus a 30-year rate, and there's oftentimes, upwards of a 0.5% difference. Well, if a 30-year fixed right now is running 6.3, I don't know what a 40-year is going to be. Is that 6.7, 6.8? What's a 50-year? Are you over 7%? And you take a look at your good faith estimate when you're sitting down with your lender and you say, what am I going to pay over the life of this loan? You're going to pay a lot more money. So keep an eye on that. There's speculation, well, geez, if they do this, we're going to have a ton of buyers come into the market and take advantage of this, which if that happened, the inventory, at least initially, could shrink, right? Or create some buyer frenzy, and there's some speculation that prices could go up. I think really what that would depend on is how many buyers in the marketplace on a national level actually are taking advantage of this and what that surge looks like. So a little bit more lender risk, long-term debt risk. You're going to be tied to a mortgage for a lot longer. So just some pros and cons in that. The overarching question that I'm getting right now, and I'm going a little longer than I normally do, but I just want to cover some things today with you guys, is, hey, we're getting to the holidays. We're projecting that interest rates might come down again. There might be another Fed update coming where we might get some more relief. We're going to wait. Let's just briefly take a look at some of the factors that could impact that. So factors that could push prices up. I surveyed a bunch of different articles, Realtor.com. I looked at many different economists, like their economic outlook and so forth for what we can expect in 2026. Well, if rates do go below 6% and they remain stable there, we have a steady job market and the construction costs remain high. That could create a pricing floor, and those factors could push pricing up. Factors that could push pricing down on the other side of this could also, be taken into account, and that is, we get a rebound in mortgage rates from inflation or market risk. So if rates go back up, we get a surge in listings. So there's still a lot of baby boomers out there that are looking to make a move. They've been sitting on the sidelines for the last couple of years, and if rates have come down to a more stable, acceptable, we could see a surge of listings come in the spring, or another economic slowdown or rise in the unemployment rate. I think the most stable, although I'm not here to predict the market, I want to make that loud and clear. I'm not qualified to do that, but the most stable scenario probably is that rates and inventory sort of balance each other out. The economy stays predictable with no major shocks or setbacks. Government's opening back up, which is great news. And, we see flat or mild growth. Looking at all of the economic outlooks, it seems like the majority of them are predicting mild or flat growth for 2026. So if you're a buyer waiting, hey, for the market to fall out or anything like that, I don't know that that's coming. So that's kind of what I'm seeing. I would guess, we're going to see a fairly flat, stable 0.5%, 2-3%, which would be a welcome turn for what we're seeing in Prescott since May 1st. So that is your November 2025 market update. If you want to give us a call, go through any of these things, take a look at what rates really are for you. If you're a buyer, talk about timing and all that stuff. We're absolutely here and would be delighted to go through that with you. And until we see you next time, thanks again.